Welcome to the next in a series of webinars brought to you by PKF Texas. We were pleased to welcome Directors Nicole Riley and Emily Smikal to discuss Governance Gone Bad, Lessons Learned to Help Your Not-for-Profit. This presentation was recorded live on May 12, 2021 as a Zoom webinar. All information was accurate and current at that time. Those viewing this recording now are not eligible to receive CPE credit from PKF Texas. If you have questions regarding this or future webinars, please feel free to email us at jlemansky@pkftexas.com and we will get back to you as soon as possible. All right, we'll go ahead and get started here. We'd like to welcome you to Governance Gone Bad, Lessons Learned to Help Your Not-for-Profit. Thanks for joining us today. Just a few housekeeping things. Everyone who attends this live webinar will receive CPE credit administered by PKF Texas. In addition to attendance, you'll need to answer one of the polling questions that the panelists have prepared today in order to be eligible for CPE. Nicole and Emily are happy to answer questions throughout the presentation in addition to the Q&A time at the end. So please submit your question through the Q&A button at the bottom of your screen and be sure to indicate who you would like to answer your question. And now we'll go ahead and introduce our esteemed panelists. Nicole Riley is an audit director here at PKF Texas, and she is one of the leaders of our not-for-profit team. She's been providing audit and consulting services to the not-for-profit community for 14 years. She works closely with management and the board of directors of our clients in meeting reporting regulatory requirements while providing value and helping them become more efficient and effective in their missions. We also have Emily Smikal. She's a tax director at PKF Texas and is also one of the leaders for our not-for-profit team. Her experience includes a broad exposure to a variety of tax areas, including federal, state, local, corporate, partnership, trust, estate and gift, and individual compliance and consulting. Her focus is on serving not-for-profit organizations along with high net worth individuals. She's heavily involved with recruiting for PKF Texas and various other firm initiatives. And I think we're going to go ahead and start off with a quick polling question, but let me share my screen so that we can get the presentation pulled up for everyone here.
All right, well, I'll take it from there, Jen. Yeah, first and foremost, the little legal disclaimer here, just a quick notice that, these are the opinions of Emily and I, not the opinions of the firm. Please don't reproduce our slides. We try to provide this information and it is ours alone. So, and then now let's go ahead and do that quick polling question, with the webinar, and we don't get to see everybody's beautiful, amazing faces. We kind of like to get just a feel for the room. So wanted to see, what is your position within a non-profit organization? Are you an executive team member? Are you a board member? Are you just kind of a staff member below the executive team? Or are you an individual that provides services to a non-profit? I know we do get some of those as well. So give everybody just a few seconds to answer that. Just as a reminder, this, if you want CPE, you do need to answer polling questions. So, all right, and wow, a heavy executive team group this time around. We usually have a little bit more of an even base, but that's awesome. Great. All right, and with that, I think we'll dive right into the bulk of the meat and potatoes of the presentation and start with, today, first and foremost, what is good governance? And, governance is such a broad topic. There are so many aspects to governance and overseeing an organization with the board and their roles and responsibilities. A board member has a fiduciary duty to the organization. They are responsible for the strategic mission, the strategic, or the strategy of an organization, that 30,000 feet. What are we doing? What's our mission? What's our vision? What programs do we need? That is a board responsibility. But we're going to kind of narrow down a little bit more today and talk more so about the accountability and the oversight piece of a board's responsibility. And, not to confuse governance with management, because management is really responsible for the day-to-day activity of an organization. And the governance is a little bit of a step back. So we need to be careful of those those lines because they can get blurred a little bit of time. Granted, it does depend on the size of the organization as well. Smaller organizations with fewer staff often have boards that are a little bit more involved, may actually be part of the day-to-day, whereas your larger organizations, the board is able to step back and to be more strategic, more high level, and management really does take over and does that day-to-day on a full-time basis. And, to really talk about what is good governance, we wanted to share some examples first of, maybe where governance didn't go quite so well. So we're going to start off with, I guess, one of the bad apples that we saw. There's so many examples of this out there, but this first one, this is Jessica Rotab. She was 33 at the time of this reporting going on, and was charged with embezzlement at her organization. As you can see, she was the former director, and actually she was the interim executive director. She didn't even wait until she got the full-time position before she started stealing. So, and amazingly, and it's at the East Texas Center for Independent Living, which is actually just over in Tyler, Texas. So this is close by, unfortunately. Surprisingly, from June of 2017 through September of 2018, she managed to siphon $526,690.83 out of this organization. So over $500,000, which is pretty sizable, given that in looking at their 990s of this organization for the last couple of years, their budget was only about $1 million of revenue. So not a huge organization, and amazing how much money she was able to get out of that in such a small time frame, because it's only about 14 to 15 months. And the way that she did it, she, and this is the court documents that were filed and the reporting that's been done around it, stated that she conducted 369 cash withdrawals, in addition to spending on the corporate card for her personal benefit. So personal expenses on the corporate card. The good news is she was sentenced to 7 years in prison, 3 years probation, and does have to pay restitution of $672,000. Sometimes some of these, I feel like they don't really get any penalty. So I was happy to see 7 years in prison for stealing $500,000 from this organization. Another example I wanted to show you is coming from Indianatown, Florida. Miss Donna Carmen was 59. She's the executive director at Indianatown Nonprofit Housing. They do low-income housing in Florida. Hers is not nearly as substantial. She only stole $50,000. But again, it was personal expenses on the credit card, as well as pushing expenses through that were for repairs on a rental home that she owned. This got a little bit more of attention probably than it would have otherwise, because the organization received federal funds. So that carries an additional charge on it because of that. And she actually got 5 years probation, no jail time, unfortunately. And unfortunately, these cases are not uncommon. If you do a quick Google search of an executive director and embezzlement, you get a plethora of responses back. But I think the important thing is, now let's talk about what we can learn from these kinds of stories. And first and foremost, and I don't know, for me at least, I don't know if you noticed, that these two specific cases, it's, credit card expenses were personal and pushing expenses through for personal benefit. These not incredibly complex or crazy schemes. In other words, it's not rocket science. So the first recommendation I have is over the executive director credit cards, statements and approvals and expense reporting. So many times I've come into organizations and I've written up my clients for weaknesses because they have the bookkeeper taking the credit card statement, taking the expenses, paying the credit card and approving everything, and off they go. Same thing with the executive director's expense report. As the executive director is their boss, they should not be approving those expenses. So I would recommend that the board of directors, either the chairman of the board, the finance committee, somebody, the finance committee chair, someone at the board level should be reviewing those credit card statements as well as the expense reports of the executive director. Another piece that I think is really important, we often see in organizations, the staff are given annual performance evaluations, but the executive director may get one every 3-5 years or none at all. So it's important that the board do a performance review every year to give feedback to the executive director on how they're doing, as well as providing a salary determination and bonus if that's the case as well. And a key aspect here, though, is having it in writing. Too many times I've seen organizations actually doing it, which is great. And they give the salary determination. They tell the executive director, we're going to give you a 5% raise. And then they provide that to the executive director. And then the executive director turns around and gives that to payroll. Not that every executive director will take advantage, but you have left a door wide open for the executive director to determine their own salary and tell payroll whatever they want. I would recommend highly that the board chair communicate that information down to the payroll and the accounting department directly. These next pieces that I wanted to talk about are a little bit more interconnected and are a very important piece of the oversight and accountability on the board, and that is looking at program accomplishments and financial statement review. You also could throw in the development department's reporting here too. And what I wanted to kind of talk about on these aspects is so many times I see boards getting the COO's report and they tell you how all the programs are doing. And then the CFO comes in and provides their report. And then the development director provides their report. And everybody comes in and gives their information, but nobody sits back and has that thought process of whether or not what each of those three are saying makes sense together. For example, if the program people are telling you that we're only serving half as many people, COVID has been crazy, we're just not able to serve people because of capacity issues and limitations. And then the finance comes in and gives their report and we're in line with budget, things are really similar to last year. And then your finance person comes in and says, we're doing great, fundraising's up, we're doing amazing. But that doesn't really make sense because, if program is down and fundraising is up, how come we're still in line with last year? What's going on? Do the numbers make sense with the actual accomplishments of the organization? Last but not least is the concept of segregation of duties or internal controls. And this gets a little tough because the board is ultimately responsible for the oversight of the system internal controls. And that means that they're responsible for making sure the policies and procedures are being followed. And this is where you have to be kind of cautious of not getting too involved because it is management's responsibility for the day-to-day, and management is responsible for making those things happen. But there needs to be some system, and many times this is part of the audit committee's charter. If you don't have an audit committee, it might be part of the finance committee's responsibilities, but something should be in place where you're overseeing those internal controls and making sure the internal controls are being followed and that they are designed effectively as well. Quick polling question, another CPE requirement here. Let's pop that up. Just out of curiosity, for those of you, since we do have a very heavy executive team here, when is the last time the executive director received a performance review? Was it within the last 12 months? Was it between 1 and 3 years ago? Have they never had it? Can't remember when they had it last. Give everybody just a few seconds. All right. That is great. Over 50% are within the last 12 months. That is amazing. I'm glad to see that. For just a couple of people within the 1 to 3 years, hopefully they can get that slimming down and get it back into the 12 months. Great to see. Wonderful. That shows that the board's doing their jobs and the board has active oversight over that. All right. Want to touch on a couple of myths that come with around embezzlement, just because I think it's important, just as a thought process as a board member and an executive team, to really not have these kinds of things in your head. First and foremost, it hardly ever happens to nonprofits. That is false. Please don't think that, unfortunately. And it's really sad because nonprofits are doing such amazing things in our community and helping people. It is really sad when we have embezzlements from them and takes away from their mission and away from what they're able to do. But please don't think that it will never happen to me. It doesn't happen in nonprofits like mine. It does. And that, unfortunately, that is the fact of the matter. My employees are dedicated, honest people. I employ trustworthy people. Everyone who works here is a really good person. Again, most individuals and fraudsters are thought of as good people. Nobody would have expected them. And at the end of the day, really only the trustworthy people are able to steal, because only do people that you trust have an opportunity, for the most part. So it does happen, and it does, trust, but verify. Try to close the doors where you can, have the controls in place where you can, to eliminate the opportunities. Another one I hear often is we don't have enough staff to have financial controls. So if you're a smaller organization and you don't have the ability to segregate all your financial controls and have different individuals on the preparation end, the two things I can suggest that are really effective is to have somebody reviewing the bank statement in detail, looking at the checks images, looking at the ACHs and the wires that go out, and then having somebody review the credit card statements directly as well, and the charges on there. Also, the important piece of that is to make sure that you're getting those documents straight from the financial institutions and the credit card companies, or having a login view only access so that the individuals, those can't be tampered with before they get to you. Last but not least, the many boards kind of hang their hat on the fact that they have an audit, and audits catch embezzlement and fraud. And although they do in a small percentage of cases, the ACFE has the percentage of frauds getting caught by external audit pretty low. The most frauds are caught by tips and hotlines. So, but what I want to point out here is an audit can be a piece of your oversight and accountability plan. It should not be the only piece. It should be a part of how you oversee staff and how you oversee and keep management accountable. Then the next thing I want to talk about a little bit is gift acceptance policies. So many times nonprofits are thankful for everything they get, and any dollar we can get from a donor, we're excited for. But it is important to have a gift acceptance policy so that management has the tools to be able to say no when it's not the right gift. I don't know if you've ever had somebody try to give you a team of horses, leave a house in their will to an organization. Being here in Texas, it's probably a little bit more common. Mineral rights on, in West Texas on land, that can happen. All of these things, although they could provide cash flow, they could provide funds to the organization, may not be great donations because of the ongoing valuation requirements. All of these things have to be valued at fair value. If you keep them, especially like the mineral rights, if you keep that for cash flow every year and it's cash flowing, you still have to get a valuation every year to make sure it's on the balance sheet at fair value. So being prepared to look at things and look at donations and whether it's within your mission, what is the ongoing expenses? Does this make sense? Maybe this isn't the greatest gift, and maybe we do need to say no because it's going to cost you more than it would provide. So another piece of good governance, and also provides assistance to management in managing the business. The last piece I wanted to talk about is the conflict of interest policy. Another great piece of good governance and an important piece. This first story, but there's a little story that goes along with it. This gentleman here is Miguel Green. He's 54 and works at the Boys and Girls Club of Milwaukee. He is the baseball coordinator. And unfortunately, he was able to embezzle $165,000 from the organization through primarily false billings to the organizations. So essentially what he would do is he would bill the organization for umpires that were friends and family of his, and friends and family would get paid for umpiring games that they never umpired. He would make up dates, make up scores to go along with all of that. He even had his cousin that was in jail at the time get paid for umpiring a game. Unfortunately, again, things happen and individuals make bad decisions. One of the things we can learn from this is the conflict of interest policy. Although it may not have derailed this one specifically, it is a prime example of where there is a conflict of interest, where an individual and related entity or related parties of them are receiving payment. Jen, if you go to the next slide real quick, a couple of real key things to have in a conflict of interest policy is to require those with a conflict to disclose that conflict or the potential conflict. That way that the board is well aware of what's going on and can make informed decisions. You should also prohibit those board members that have a conflict on voting on those matters, state how you will manage those conflicts, and then have an annual discussion. The key thing I wanted to point out is it's not prohibited from having conflict of interest. For example, if you have bankers on your board, or if you have a banker on your board and you need to go out and you want to get a new bank, the bank of that member is not prohibited from providing an RFP and being part of the bidding process, but they cannot vote on whether or not to go with that board member or whether to go with that bank. They have to recuse themselves. And if you get a competitive offer and you get competitive bids and their bank is the best option, you can go with it. But the board needs to be aware that conflict exists and they are making that decision well-informed to make sure that the well-being of the organization is at the forefront of their decision-making. And with that, I'm gonna turn it over to Miss Emily to talk about some other things on the 990 and tax side.
All right, thank you, Nicole. So today I'm going to point out a few bad governance red flags that you could actually spot on Form 990. And I'm also going to talk about a few common IRS audit triggers and what to do if you do get selected for an IRS audit. So first of all, Form 990, as you know, it serves multiple purposes. Yes, it reports things to the IRS, reports your financial data for the year, but we really often say that it tells the story of your organization. There's many items on the form that for example, you put your mission on there. You tell them kind of how things are ran in your organization. So it tells the story not only to the IRS, but to the public. Form 990s are available to the public. The IRS publishes them on their website, and then there are charity watchdogs out there like GuideStar that pull these and report them on their websites as well. So the public can easily see what is reported on your 990. The IRS intended the Form 990 to provide transparency and governance, really, to ensure that not-for-profit organizations are doing what they're supposed to be doing. It includes numerous disclosures and encourages not-for-profit boards to adopt governance policies and procedures that's going to monitor their activities and report how the money that is being entrusted with them is being spent. So one example of governance gone bad is the now pretty highly publicized college admissions cheating scandal. Unfortunately, I'm sure you've heard of it. Unfortunately, it involves our dear Aunt Becky. But this story, just in case you don't know, quick synopsis, this story involves the rich and famous, some of the most elite universities and colleges in the nation. And at the center of it all, a non-for-profit organization that allegedly engineered more than 800 bribes and other initiatives to benefit the children of its wealthy donors. That tax-exempt entity, Key Worldwide Foundation, was right there at the center. And while there's lots of news out there in the media about all the ethical implications and what happened, how this foundation orchestrated numerous cases of fraud and deception. Now that this organization is under so much scrutiny, as I just mentioned, the 990s, as we know, are public information. So now that this has all come to light, folks have been reviewing those 990s that are on the IRS website and have pointed out a few red flags that really indicated poor governance. Now, these red flags, they don't automatically point to fraud. We know in this case it did, but it wasn't caught by the 990. However, they do give us some great pointers on some things to watch out for. So as many of you on this call are board members or part of management, what are some things that you should be looking at on your Form 990 prior to it being filed? So a few of the specific red flags that were on this particular foundation's 990 that folks have now kind of, like I said, done some digging and pointed out. First of all, their 990 indicated that the review process was only that the president would review. So there is a question on the form that asks you to explain the review process of your Form 990. And there's specifically just said, our president will review. It didn't mention the board. It didn't mention the finance committee. A board of directors or a finance committee should have had oversight on the foundation's finances and activities. So do not just have one person reviewing your 990. Their particular Form 990 also stated that their documents, their governing documents, their conflict of interest policy, financial statements, not made available to the public. That's another question on the form. It says, tell us whether and how these documents can be viewed by the public. Most of the organizations that I've seen say on our website, or at the very least, available upon request, but theirs specifically says not available to the public. That indicates a lack of transparency. They also checked no to the questions on whether or not they have a whistleblower policy, whether or not they have a document retention policy. These items are suggested by the IRS to have. Another thing that looked a little fishy on their most recently filed form is that their functional expense allocation wasn't in alignment. It didn't make sense for an organization of their size. So in their statement of functional expenses, for example, in their case, they had almost all of their expenses, I would say probably 95%, in the column for program services expenses. Very, very little was in management and general expenses. We know if you've got HR, if you have accounting, things like that, those expenses are probably primarily management and general expenses. Yes, there could be some allocated to program service expenses, but just be mindful of the allocations. There's clearly was not, it did not look right. Something looked off. And now that we know the end of this story, we know that the biggest red flag was actually that they had donations made to other organizations with no records substantiating those organizations' eligibility or the selection process. So basically there was no monitoring the use of these donated funds, and it left the door wide open for the reported misuse of these funds. And instead of helping low-income students, which is what their mission said on their 990, it didn't help low-income students, as we know, at the end of the day. It instead served these wealthy donors and their children. So one thing I also wanted to point out with this story is this foundation actually did file the appropriate form with the IRS. So they filed their 990s. So don't think that, oh, it's kind of a check the box, I get it done timely, everything's good, I don't really need to look at it that closely. Now, they did that, but the problem was that no one really paid enough close attention to realize that there were irregularities with the form. So that is where you come in, is reviewing this and making sure these items look right before this is submitted to the IRS. All right, so a couple of common IRS audit triggers. Everyone wants to know, am I going to get audited? How do they pick who gets audited? So just wanted to run through a few of the most common ones, and we'll dive into a couple of them a little further. But first and foremost is referrals. So you can be referred to the IRS from a state agency. Maybe you filed something incorrectly or didn't file for payroll issues, things like that, and the state could report you to the IRS. Another common one is individuals. So whether that's current or former employees, maybe board members, maybe the public, anyone can report your organization to the IRS. There's actually a form out there, Form 13909, and it's a tax-exempt organization complaint form. Anyone can file this at the IRS to basically give them a heads up, hey, you may want to look into the organization. Now, if that is filed in your organization, it doesn't automatically mean you'll be audited, but the IRS will consider it and determine whether they think it's worthy of doing a full audit. Other common triggers, maybe you have foreign activities, especially if you have some foreign bank accounts that you're not reporting. You may have discrepancies of fundraising income versus fundraising expense. For example, you have a large amount of fundraising income, you don't have much fundraising expense showing. You may have a valid explanation, but these are just common triggers of, hey, something could be off here. Compensation issues, that's a big thing with nonprofits right now. So both unusually high executive compensation or even low compensation amounts in relation to the size of the organization could be triggers. And then the last two are two that we're going to dive in a little deeper on, is Form 990 indicators, specific things that you can see yourself on the form, and then unrelated business income. So Form 990 indicators, as a board member, as a member of management, what is something that you should be looking at, you should be reviewing on your 990? So first, let me say the IRS is a bit behind in technology. Trust me, we try to deal with them every day, and it's painful sometimes, but they are getting better. And they now use a data-driven selection process to help them select organizations for audit. So what this means is organizations could be automatically selected for audit if certain data is detected by this automated process. So it's a lot more electronically driven these days, a lot easier for them to identify some issues. So you want to make sure that your 990 is first and foremost complete. You don't want to leave any missing schedules or parts of schedules, or perhaps your name and your federal identification number, there's some mismatches there. There's a Schedule O, if you aren't very familiar with the form. Schedule O is basically just kind of a catch-all form, a catch-all schedule at the end. And there's several questions throughout the form that say, on Schedule O, please describe X. For example, that review process that we talked about earlier, in which that foundation just said, just our president will review. That's on Schedule O. So that Schedule O is where you list a lot of these answers. So you want to make sure that you read through all of the questions on the form, and if it says to provide more detail on Schedule O, make sure that it's there. Also, there's a part 4 of the Form 990 is called the Checklist of Required Schedules. It asks a lot of questions that if you answer yes to, require additional schedules. Now, I will say you don't have to be a CPA to understand this. You don't have to pull up the form instructions. You can clearly read through these questions, and it will very clearly say, if answered yes, fill out this schedule. So you can do this, you can review this and make sure these are all there. Just a few examples of this. It says, One of the questions is if your organization owns land or buildings or equipment. You check yes. If you do, then you need to fill out a portion of Schedule D. Another one is if your organization reported more than $15,000 of fundraising event gross income. If you check yes, then you need to fill out a portion of Schedule G. So read through that, make sure that everything is complete. Another commonly missed thing is around political campaign activity. If you have that, make sure that you describe your organization's direct and indirect political activities and expenditures. Often that's just left off. Huge red flag. Another red flag is if you have a diversion of assets. So there's a question on the form. Was there a significant diversion of the organization's assets? What this means is any unauthorized conversion or use of the organization's assets other than for the organization's authorized purposes, which often includes embezzlement or theft. So you do need to report that if that occurred. And again, none of these are automatic means to an audit, but unfortunately, it is a red flag to them that they may need to look into things a little closer. And then just a couple of easy things I wanted to point out on the form that you can see. So if on your statement of functional expenses, you report fees for non-employee services, yet on the question that asks how many Form 1099s did you file, you have 0, that could be a problem. If you have non-employee services, you very likely issued or should have issued Forms 1099s for those. There are some cases where you don't, so that could be the right answer. But these are just things that you should question. Another one is compensation and Form W-2s. If you report compensation, yet you say we didn't file any W-2s, that might be a red flag. Why was that? So you should be asking those questions just to make sure that the answer makes sense. And one other thing to point out on this is if you do get selected for an IRS audit, we all know, the biggest problem usually is just the headache that comes along with it. No one, at least I don't believe anyone is ever sitting around one day and think, I hope I get selected for an IRS audit today because my to-do list was running a little short. I was hoping for something to do. If that's you, more power to you, and I envy you. But it is a headache, and we understand that. But a lot of times for not-for-profits, they're just wanting to make sure that your organization is doing what it's supposed to be doing. And so it doesn't really result in much more than a headache. Not all the time, but sometimes. It may not result in additional tax. It may just be a process in which you have to prove what you're doing. But it could uncover some other things that could really result in some penalties. For example, the 1099s that I just mentioned. If you don't file 1099s, there are penalties for that. And so it could actually uncover some things that do result in some out-of-pocket expenditures there. So just wanting to point out that in addition to the headache it causes, it actually could result in some other bigger, longer-term headaches. And then unrelated business income. This is a big topic in the not-for-profit world. So I wanted to touch on this a little bit. If you don't know what this is, let me just give you a really quick summary. So to be unrelated business income, there's 3 steps. 1, the activity has to be a trade or business that is engaged in for profit. So services or providing goods. You're doing this intending to make a profit. 2, the activity is regularly carried on by the organization. So if it's like a one-time deal, probably not considered UBI. And 3, the conduct of the trade or business is not substantially related to your organization's exempt purpose. So if you've got income from an activity that meets all 3 of these requirements, you have unrelated business income, which is required to be reported and taxed to not-for-profit entities. So the IRS recently conducted a multi-year compliance project on tax-exempt colleges and universities. And while that study was limited to the institutions of higher learning, the IRS did note several major problems in the unrelated business arena, which I think are good cautionary tales for the entire charitable sector. So I wanted to pull in a few of those lessons learned from that study. So the first question is, have all sources of your unrelated business income been identified? So some of the most common sources is one is rental income received from debt financed real property. For example, if you've got a mortgage on a property, yet you rent it out and have rental income on that, that income is actually unrelated business income. So the IRS can easily spot this, because if you show that mortgage, that liability on your balance sheet, and you show rental income on your statement of revenue, most likely you should have a Form 990T, which is the form on which you report unrelated business income, showing that rental income. Now, it could be that that rental income is from a separate property, which you don't have a mortgage for. So again, it could be the right answer, but something to look at a little closer. Also, other common streams of UBI, advertising. Maybe you put out a newsletter for your organization and you sell advertising slots. That advertising income, while you are using it likely to further your mission, the act of selling advertisements is most likely not related to your organization's exempt purpose. I know we have several social clubs on the call today. So things like facilities rentals, pro shop sales, greens fees to your non-members, those are unrelated business income. And then another one that we see a lot is parking lot income. Let's say you have a building near Minute Maid Park, and for Astros games, you let folks pay to park in your parking lot. That income is unrelated business income. So the good news of all this is that you can take expenses against unrelated business income. However, you need to make sure it's the right expenses. So the next question to really think about is, how reasonable is your organization's allocation of expenses to unrelated business activities? So, and expenses that are related to your organization's mission cannot be used to offset this unrelated income. If you use personnel or facilities for both unrelated and related, then you need to have a reasonable allocation of your expenses between the two. This is something that is being much more closely looked at by the IRS right now. Someone just sent in a question to repeat the 3 qualifiers for UBI. So let me do that right quick before I move on. 1, it needs to be from an activity that's a trade or business that you're engaged in for profit, with the intent to make a profit. Maybe you didn't actually make a profit, but you intended to make a profit. 2, the activity is regularly carried on. So the frequency matters here. And 3, the trade or business is not substantially related to your organization's exempt purpose. So those are the 3 qualifiers for UBI. All right, let's do one more polling question. If you've made it this far, congratulations. So how many of you have gone through an IRS audit at your organization? Yes, no, or it was so painful you completely blocked it from your memory and you have some kind of vague recollection, but you're not sure. Let us know here. Wow. We've got some good luck on the call. We need to take you guys to Vegas or something. Sounds like a good group. All right. Well, good news for you. And hopefully that will be your answer for the rest of your lifetime. But you know, the IRS is pretty unpredictable at times. So we've pulled together some tips from folks who have survived IRS audits on things that you can do now that, one, is just kind of goes along with this whole good governance thing that we're talking about today, but also will help relieve some of the headache that could come along if you do get selected for an audit. So first of all, keep a binder. And when I say binder, it could be a physical binder that you lug around, or probably you won't lug it around, but that you have somewhere, or it could be electronic. But keep a binder with key organizational documents. such as your articles of incorporation, your IRS approval letter, your conflict of interest policy that Nicole mentioned earlier. These are important documents that you would probably think, doesn't the IRS have this stuff, especially our approval letter that came from them? One would think so, but they ask for these things. It makes no sense. I understand, but the IRS is a fickle organization at times. So keep these things all together somewhere that you can easily access. It's important because if officers or if board members change over the years, these documents could actually pretty easily get lost in the shuffle. And when it comes time to find them, that could be the biggest headache of it all, is looking for these things that perhaps were done 20, 30, 40 years ago, however long ago your organization was set up. So that was something that someone pointed out, is make sure you've got these pulled together and someone, probably multiple people, know where they are in case that someone is no longer there. Another tip, keep a binder for minutes of any board or any committee meeting. Keep these on hand, and also put a sticky tab or something, some kind of indicator on each page where a motion was approved. That way those are easy to find. You don't have to search through everything to find these types of bills. Another tip was to keep those board minutes as brief as possible. Just kind of put your action items on there. My experience with the IRS has always been less is more. Definitely answer their questions. Definitely give them what they're asking for. But if they ask you what you ate for lunch yesterday and you say, and also my favorite color is green, they may say, oh, tell me about that. Why is your favorite color green? Don't open the door for them to ask any questions that they didn't already ask. If they come back and ask you later, just out of curiosity, why your favorite color is green, sure, you can answer it then, but don't open that unless they do, because it could bring up things that was not going to get uncovered, and now it's just causing more headaches. So in your board minutes, because that is something they may ask for, keep them as brief as possible just to prevent some of that headache if the time comes. Another thing, at the end of the year, pull all of your brochures, reports, and newsletters from the year, put them together in a folder somewhere. The reason for this is that in many cases, most of the questions that IRS asks nonprofit organizations during their audit, it's not actually about the finances and all your financial stuff. Again, it's a lot of times they're just looking to see if your organization is doing its exempt purpose. So they're likely to ask a lot more about the organizational structure and the activities of the organization. So that's why these items are good, your brochures, your newsletters, that sort of thing, to keep together to help support your argument of that the organization is doing what it's supposed to be doing. And then save all of your financial documents in line with your document retention policy. So first of all, have a document retention policy. And secondly, follow your document retention policy. Keep all of this as it should be, and it should help the process go much smoother. And last but not least, stay calm. It's not the end of the world. Now, if you were doing things you shouldn't be doing, then you may not be quite as calm, but stay calm. You're not in this alone. You're doing your job. They're just doing their job. And more likely than not, at the end of the day, it just kind of caused some headache, and you're able to prove everything you were doing was legitimate, and all's well that ends well. So that is what I have. I know on the next slide, we have a few resources for you. Nicole, did you want to give a little detail on what they can find with these?
Yeah, these three are pretty well known. They're nonprofits themselves, and they are dedicated to helping those nonprofits and their governance structures. They have a lot of templates. So if you don't have a conflict of interest policy, I know for sure Board Source and National Council of Nonprofits, they have examples and templates out there. They have documentation retention policies. They have whistleblower policies, all of those things. There's a lot of good examples out there. They have great articles if you're looking for some additional information, but just three great organizations that have a lot of lot of things that you could access and use if you need more information or you need some templates. And the other thing I wanted to mention, Emily, on your last slide, as far as the tips on the IRS Audit Survivors, if you undergo an audit, you probably have all this stuff together. If you've never undergone an audit, having all of that information handy for in case you do undergo a financial statement audit would be really helpful, because pretty much all of that is requested by an auditor. As if my team comes out, they're going to want to see all of those things. So it would be great if you have them all handy already and ready to hand it over, and it makes the whole audit prep process much easier.
So IRS audits and Nicole audit. Both of those.
With that, we wanted to open it up to questions from the audience and see if there's anything you wanted us to kind of touch on a little bit more, kind of go back and emphasize. If there's anything anybody has burning at their fingertips, we'd love to hear from you.
Or even if you were one of the few unfortunate ones who have gone through an IRS audit and had a little tip that you wanted to type in the chat box and we can share with the group, happy to do that as well.
Yeah, the unlucky 7%. Maybe they don't go to Vegas.
Yeah, probably not a good idea. The good news is the IRS is very busy these days, and so perhaps
yes,
it's busy to do a whole lot extra, but wouldn't bet on it. Wouldn't bank everything on that.
You never know where those things are going to come from, what's going to trigger them. They're getting better. They're getting smarter. They're coming around to the 21st century, starting to get the data mining into place and really being able to see some of those red flags. I've seen more and more articles about it.
Finally. All right. Well, we definitely hope that next time we do one of these, we get to see you guys too. We miss having you here in our office. So hopefully next time it looks a little different, but definitely glad you joined us this way.
All right. One of the questions, what other ways can one assure that the CEO is being held accountable for financial results? Well, first and foremost, I think if you're doing performance reviews of your CEO and you're setting goals, setting a standard of the things that the board wants to see, they know what they're supposed to be doing. So they would be held accountable to meet those goals the next year. And I caution you on too many financial results and too many targeted financial results, because be aware that when you set a specific financial target, and in general, just whatever your target is, that can modify behavior. So if you want expenses to stay at a certain level, they may sacrifice programmatic results to meet that financial result. If you are very heavy and pressure certain contribution results over programmatic effectiveness and results, they could maybe get in a lot of get in contributions, but not have the effectiveness of the program happening too. So you have to be cautious of how you set those specific financial results for a CEO to meet, and you want to make sure that they are weaved into programmatic results, fundraising results, and all of it kind of is complementary and not overly specific. Because, for example, I mean, if you want, in our business, if we want charge hours from our staff, it's very likely we'll get charge hours from our staff, but how effective are those charge hours that we're getting? So you have to be kind of cautious on some of those. But I think a performance review is one of the best ways to keep the CEO accountable and to set those standards in the first year, and then whether or not they're meeting those standards, and then setting the standards for the next 12 months at the next review.
We got a question regarding UBI and then a story from one of our unlucky 7%. So let me address the question first. The question is, if advertising revenue is far less than the cost of publication, do you still need to report it as UBI? And that's assuming that those costs are in fact eligible to offset. So there's a threshold and it's $1,000. And if you have more than $1,000 of just revenue without considering the expenses, you are required to file that Form 990T and show that as UBI. However, on that Form 990T is then where you'll knock off the eligible expenses. So it could be that your net income from that is nothing or is a loss. But yes, you are still required to report it. It just may not result in any tax if you have enough expense to offset that.
Emily, do we have quite a few clients that have that, where we have advertising income and then between the expenses and the subscription expenses, it's pretty negative?
Yes. Yeah, that's not uncommon to see from really any kind of unrelated business income. Especially, for example, our social clubs, they've got quite a bit of unrelated business income if they let non-members come and do things. But 2020 probably was not a year in which they made a whole lot of profit on that. So I fully expect to see losses from those activities for the most part. Let's see if someone wanted to share. So their organization went through an IRS audit, and an item for discussion was related around the categorization of contractors versus employees for dance teachers that work part-time. So just a good tip to make sure that you're classifying these folks correctly when it comes time to filing those 1099s and those W-2s at the beginning of each year.
And I'll take this next question. Individual says their CEO approves staff bonuses that do not go through the finance committee or the board. It is a very small percentage compared to our overall budget. Should we review that? And the CEO bonus is approved by the chair and the chair-elect, and annual review is done by the board of directors. So glad to see the CEO bonus is approved. That is important because that is the board's responsibility. I think it's very common for the CEO to approve staff bonuses and decide what those bonuses should be, especially if they're within budget and they're budgeted already. That's the discretion that they're given, especially because that's day-to-day management usually, and that is their roles and responsibilities. Obviously, you as the board is going to see that it comes through as a budgeted line item. It's not excessive. I do see where a lot of people the CEO will provide that information to the board as a FYI, and just to see that there's either no favoritism or that they're in line. And maybe so more the question is asked is, how did we determine those? Is it based on any specific criteria, how their performance was? Is it completely discretionary? Those might be good questions to ask, but I think it is within the CEOs, and maybe, everybody has a different opinion on that, but probably within the CEO's roles and responsibilities if you've in charge them with that. Well, and we're getting down to the end here. I'd like to say thank you for everyone for tuning in. Great to have you this morning. I think hopefully everybody has a great day. And I know Jen has just a couple of housekeeping reminders here before we log off.
Perfect. Great job, ladies. Thank you so much. Appreciate the information you guys shared today. The presentation along with the recording of the webinar is going to be posted to a page on our website as well as the PKF Texas YouTube channel. You'll receive a pop-up link when the webinar ends with an evaluation. Please take a few minutes to provide your feedback as well as sharing additional topics you'd like us to cover, because your feedback's very valuable to our future webinars and seminars, like Emily said, hopefully in person soon. And then the links to everything will be sent in a follow-up this Saturday. So be looking for that as well. And hope everybody has a great day.
Thank you, everyone.
Thanks, everyone.
Thank you for watching this recording of our Zoom webinar. A quick reminder that watching this video will not qualify you for CPE credit. For more information about PKF Texas's upcoming webinars, contact Jay Lemansky at pkftexas.com and stay tuned for future topics.